This is Capital Ideas TV. Coming up on the show, the CEO of Pioneering Technology on the company's patented Smart Burner. The head of Drone Delivery Canada on first mover advantage in a hot sector. We've got the CEO of Aequus Pharma. Can he build another billion-dollar business? And the chief executive of Solar Alliance strikes some deals. Hello and welcome to Capital Ideas TV. I'm Mark Bunting. Pioneering Technology has a patent on its Smart Burner. They're used in electric coil stoves to prevent fires. The company's patent runs through 2030 and they're growing their revenue on an annual basis at more than 50%. Here's our conversation with the CEO of Pioneering Technology, Kevin Callahan. Kevin, I'm sure you've got your pitch down as a former advertising guy. What does Pioneering Technology do?
We engineer and manufacture products that help prevent cooking fires. Cooking fires are the #1 cause of household fires in North America. So virtually 50% of all fires in the United States are related to cooking.
And your main product is Smart Burner. Tell us about that.
Smart Burner is our big seller right now. It's a new product. We just launched it a couple years ago. It's the evolution of an earlier product called Safety Element. What it does is it controls the high-end temperature of an electric coiled stove. It's an easy plug-and-play version of the Safety Element product. So you literally just pull out an electric coil, stick the Smart Burner in, makes your stove look better, but more importantly what it does is it will never get hot enough that anything can auto-ignite on your stovetop. So it prevents fires. And we've installed a couple 100,000 of these products this far and never experienced a cooking fire.
I've seen your ad for Smart Burner, and it has a comedic tone to it. Again, you have an advertising background. Why was that decision made? I'm curious.
Dull, boring, and old. Very, very old. The electric coil stove really hasn't changed in more than 150 years. But even if you are named after your great-great-grandmother, Edna, why use her stove? This is Smart Burner, the fastest and smartest way to transform and update your electric coil stove.
Well, at the time, that was a video that was created for online. So it was a way to try and get the product out there and go viral. We were looking at taking the product to retail. And we just thought it was a better way, especially online, to engage the consumer. Interestingly, the actor in that particular spot has become a big hit.
Is that right?
The original spot was about 2 minutes long and wasn't as well received because I think we went a little overboard, but the 30-second version worked out well on television. And I will add that as a fairly young company, we don't do a lot of TV advertising. We had a very good deal on that because of my past experience.
Oh, I see. Very good. So you've got a patent on Smart Burner through until 2030. So does that give you, is that a nice moat for you, or is there potential competition? Could other companies come up with something similar?
I don't think similar, but there's always the potential for another company or a big equipment manufacturer to design around the patent. But one of the interesting things that happened with our business, we've been at this for a while, specifically on electric coil, is that the standards are now changing. So the manufacturers, as of April 2019, won't be able to sell an electric coil stove in North America that doesn't meet the new standard. And at present, we have the only technology that meets that standard.
So what does that mean for you once that law comes into effect in terms of volume and sales in general? Well,
it means a couple of things. Potentially, we could wind up replacing the equipment manufacturer's existing component supplier, so the supplier of the coil elements. And the coil element hasn't changed in over 100 years. So that's an opportunity. But certainly a very large opportunity is the aftermarket. There are tens of millions of electric coil stoves in the United States that are still creating problems, all of which is our current focus. So if we were to do a supply deal or a licensing deal with the OEM, that would be over and above and a real bonus.
So you're talking about potentially a Whirlpool, for example?
A Whirlpool, the three big companies in North America are Whirlpool, Electrolux, and it was GE, but GE sold their appliance business to Haier, a Chinese-based company. So those are the big three, and then there are a few smaller independents in North America.
Kevin, tell us about some of the contracts your company has.
Well, we have hundreds and hundreds of contracts across North America, so end customers, and they'd all be big brand names. So Our focus is the multi-residential world, so it's affordable housing. So a big example of that would be Toronto Community Housing. They're the second largest in North America, and we have many of those. Universities and colleges, so you name the university and college in the US or Canada, we have product installed on campus. The US military is one of our biggest customers, and we have installations with them on bases all over the world. And then lots of seniors facilities throughout North America. And actually, interestingly, we've just started working with some very large hotel chains that I can't name.
Okay, fair enough. Now, a couple of years ago, you made the decision to be less of a consumer-focused company and go more business to business or B2B. What went into that decision, and how has it worked out for you?
Well, the reality is when we defined our focus on cooking fire prevention, and it's not a well understood category. We created the category, and it's massive because it's a huge problem. The problem is well understood in the multi-residential world. So for instance, someone like a Toronto Community Housing, they have a number of cooking fires on an annual basis. So they understand the problem and they were looking for a solution. In the consumer world, it's not as well understood. But when you do tell people, so for example, when we ran that ad and people saw it, because the product, we got a listing at Home Hardware, they look and they go, wow, I didn't realize that was such a big problem. What a great idea. Can't believe it's not already being done. And then they say, it would never happen to me, but I'm going to buy one for my mom or my son who just went to university. The reality is that cooking fires happen to everybody.
Tell us about the potential market size. You've been sort of hinting at it here. What dollar amount are we looking at?
Well, the industry's huge. Every household in North America has a stove. The product we were just talking about is only the electric coil market, and you probably noticed that in most homes you go into, they have glass tops or gas tops. But in the multi-residential world, they need a more robust cooking platform, so it tends to be electric coil. Also in rural or lower income areas. So that market in North America alone, on the aftermarket side, is worth about $4 or $5 billion. In terms of new shipments of stoves annually, it's roughly about 7 to 8 million new stoves get shipped each year in North America, so it's a big market. And we're working on technologies as well for the other platforms, both glass and gas. We do have solutions now, but we're working on some even more interesting stuff.
Interesting. Now, in terms of fundamentals, you grew revenue in 2016 by more than 50% year on year. What are you expecting this year? What's your profitability like right now?
Well, we forecasted 50% last year. We surpassed that. We forecasted 50% again this year, and we're on track to do that. We just closed our second quarter, and we're running at about 80% year over year. In terms of EBITDA, it'll be roughly 30% of our gross revenues. Net income slightly less. So we're tracking very nicely right now. CAGR over the past 4 years is just about 70%.
Right, your compound annual growth rate. Yeah, okay. Now, insiders own, including you, more than 30%. What do you think that says to shareholders that so many insiders are nicely vested in the company?
Well, I think what it says is two things. One, we all believe in what we're doing. We always knew that this was a big opportunity. It wasn't a matter of if, it was when, and whether we had the fortitude to see it through. I think there's something interesting in that everybody gets up every day, and not only are you trying to build a business, but you also have an impact on people's lives. You're making a difference. So that's quite rewarding. So people come with a sense of purpose. Every share has been paid for. Nobody's sold a share. I mean, I think everybody believes that this business has got a long way to go.
And what's the end game here, Kevin? CEOs sometimes are loath to talk about the possibility of getting taken out, but would it make sense if you keep growing this way the next couple of years that a Whirlpool or whomever would come by and say, we have to own these guys?
It's very possible. I mean, we certainly have some thoughts on how big we think this can get, so it would have to be a pretty good offer. Mm-hmm. But yeah, I mean, that is a potential end game. I mean, there are other opportunities, I suppose. I mean, we've been looking at other ways that we can grow the business, either through R&D or acquisition with similar or synergistic businesses. But yeah, the end game would be somebody in the appliance industry or the fire safety industry, I would think.
A few months ago, we had a cover story in our Capital Ideas Digest on Drone Delivery Canada. Today, we talked to the CEO. He says his company has first mover advantage in its sector, and they're very close to generating revenue. Here's our conversation with the CEO of Drone Delivery Canada. Tony, last time we talked, you described the drone sector as similar to the marijuana sector a couple of years ago when it was just starting to ramp up. Do you still believe that? And if so, why?
I think so. It's, if we look at the two industries and put them in parallel, it's all about licensing and getting through the regulatory barriers. And we've been working very hard for the past 3 years with various regulators, the federal government, just really trying to understand the right way to bring this technology to commercialization, to fruition. And I think there's a tremendous amount of upside in this space, and we've positioned ourselves adequately to get there.
So there's a lot of talk about drones, a lot of sort of variations and applications. What specifically does Drone Delivery Canada do?
We picked the hardest vertical out of them all, and where there's the biggest risk, we believe there's the biggest reward. And when we looked at the space, we looked at all the different areas such as surveying, photography, and so forth. But what we saw was lacking with this model, with those models, was there was literally zero barrier of entry. So if we have to invest our time and our capital to enter this new space, we're really looking at a market where we know the potentials, the upside potentials are drastic, and that's what really makes our vertical very different than most.
Now you want to focus initially on rural and remote areas, so give us some real-world applications with your technology.
So I just came back from northern Canada. I spent 3 days in a remote community, approximately 2 hours away from by plane from Toronto. And as a Canadian, it was an eye-opener for me. Literally, we're stepping back 200 years. As a person who lives and works in a major area, I never really thought these types of communities existed, but it exists. And the applications for these types of areas, what's lacking is infrastructure. So although the government says, okay, we're going to go build roads and we're going to try to help these people, this costs a lot of money, takes a long time to get there. With this type of technology, it's an infrastructure play for remote Canada. And we see that's the starting ground for this type of business to commercialize.
So, for example, you would deliver water or various types of supplies or emergency medicines, that kind of thing.
Medical supplies is a big problem, mail. We understand for this one community we visited, it takes 10 days for them to obtain an average mail. Medical supplies, if it's not in their community, it's a week. And if they need it urgently, it's thousands of dollars to access these goods. So with this type of technology, it becomes now just in time, becomes very affordable, and it's a green technology.
So you think you've got first mover advantage.
Absolutely.
Is there anybody nipping at your heels, or you've got this space to yourself?
No, we saw the space early enough. Many people say we saw it too early, but we've been able to immobilize in the space, assemble the smartest minds, and really work very closely with the regulators, which is really the key to all this. You can have the best idea in the world, but if you can't commercialize it, it's just an idea. And we've been very fortunate that our federal government is very pro-technology and innovation focused, and we're there. We are, today we're the only ones.
Last I heard, you had contracts with the likes of Staples and Napa Canada. So tell us about some of the other contracts you have and some of the other types of companies that you're working with.
Yeah, actually today we announced a partnership with the region of Peel for their first responders unit. Their challenge that they're seeing with first responders is due to density now, levels of traffic. They have impacting factors getting to emergency sites. And we're working with them to develop an AED platform, a defibrillator on a drone, and really getting them out to emergency situations and potentially saving lives.
That makes sense, instead of the emergency vehicle sitting in traffic and not being able to do anything about it.
Exactly. Exactly.
So how close are you to commercialization? You're talking about towards the end of this year?
Yeah, we anticipate by late November, we're going to be obtaining our compliant status certificate from Transport Canada. which essentially brings us to a level of commercialization. We will be the first and only drone delivery company in Canada to have obtained this level of registration from the government.
And then at that point, what does revenue look like, and when are you profitable? Take us through that.
So we're going to be launching in remote Canada, in these northern communities to start, and this technology is all about starting somewhere to get somewhere. We're going to be starting there. We're working with several partners, as you said, Staples, Napa, Region of Peel, and there's several more that are going to be being announced shortly. But we're going to be starting there, laying out the infrastructure, so we're going to start seeing integration fees and setup fees, and then we're going to start seeing monthly reoccurring revenue fees, processing deliveries. And we've been active with Canada Post. We've been in the Canada Post review sessions since last summer with them. And mail delivery, we believe, is a perfect utilization for this type of technology.
Is it possible to project quarterly revenue into, say, 2018, or is that too tough to do right now?
It's on a model. The model looks great. This business, because it's heavily focused on automation and systems, it's very EBITDA rich. And once you get to maximum utilization, money just starts falling to the profit line. So we're looking at about 60% EBITDA margins upon commercialization, and looking to break even very, very quickly.
Okay. And then as far as your cash position, you're nicely cashed up to ramp up?
Absolutely.
Yeah.
We had a phenomenal raise earlier this year. GMP led the raise for us. It was predominantly institutional. They came on board. Today we're sitting just shy of about $10 million in the bank, and we're very well funded to move to commercialization. And
Tony, what are some of the risks for your company? What are some of the challenges and even the obstacles you've already faced?
Tremendous amount of obstacles. When we started this business, we put up a board, and basically it was what if, and this board just kept growing along the way. One of the biggest challenges we found initially was, where do you find people to really bring this technology to fruition? And we were fortunate enough to partner with leading academics in this country, that the government had basically created a drone UAV research program, and they're the ones who essentially helped us launch the platform moving forward. Today we have a staff collectively between internal and external, about 50 people working, and we're very, very active. Our team just came back from Foremost, Alberta to do testing, the first beyond visual line of sight test for a drone delivery company in this country, and it went off without a hitch.
Lastly, what would you say to shareholders or potential shareholders who may be looking, I guess more so potential shareholders who are looking at your company saying, well, they're small, it's unproven, I don't know, there's no revenue. What's the investment case to compel them to think that, hey, this is a company I need to own?
Absolutely. It's a net new industry. We're seeing major investments happening around the world. This is just not a technology that we're doing here. It's rolling out globally. And the opportunity that we have that maybe doesn't exist south of the border is that we have a very favorable regulator that's working with us really to prove out this technology here in Canada in the right geography. And then once we're there, then there's a potential of exporting the technology globally, and we open up an enormous market on a global stage. So it is early, but we believe that it's a tremendous upside.
We've got some insider activity for you. This is when we take a look at officers and directors and the various insider buying and selling that they're doing. We're taking a look at Entreg. This company specializes in cranes and trailers and tractors. We've got 4 insiders taking advantage of lower prices here at 15 cents a share. In fact, you've got a director increasing his stake in the company by 80%, the executive chairman increasing his position by 37%, and the CFO, again, taking advantage of weaker prices here, buying in, increasing his stake by 37%. Investors like it when the CEO of a company has had success elsewhere. That's the case with Doug Janzen. He used to run Cardiome Pharma. He turned that into a billion-dollar company from a $50 million market cap. Can he do it again at Aequus Pharma? Here's our conversation with Doug Janzen. So Doug, tell us about the two main products that you have that are already on the market.
So the first two drugs that we launched were two drugs from Sandoz, Canada. So Sandoz is the generic arm of Novartis, and most generic products don't need salesmanship. They need to be distributed. So what generic companies are really good at is manufacturing and then having a semi-trailer arrive at Walgreens at 1 o'clock and then at a pharmacy at 2 o'clock. But in the case of the two drugs that we're selling for Sandoz, they needed a sales force. The first product we launched is a drug called tacrolimus. That drug is used after transplant surgery. It's an anti-rejection drug, so patients will take it for the rest of their lives, and it prevents organ rejection. Transplant clinicians are very hesitant to switch patients to a generic. If the drug isn't doing exactly what they expected it to do, you've killed the patient. So with Sandoz, Novartis Group is one of the global leaders in transplant, and as tacrolimus went generic, Novartis transitioned that product from their branded group to Sandoz. It's manufactured in the same facility. It's the same product manufactured by the same group. And there's 21,000 patient years of data showing that it's bioequivalent. So that information, we get in front of transplant clinicians across Canada and we explain why Sandoz TAC is the same as Novartis tacrolimus, and that drives sales. So we've increased sales, a few multiples from what Sandoz was previously selling, and that's where we generate our revenue. Vistitin is a drug used for glaucoma. It was on the market. Allergan used to sell Vistitin 3.0 in Canada, and then as the patent life was about to end, they withdrew it and they launched a different version of it. Physicians were aware of the product. They had a lot of expertise and history with it, and we reintroduced it back into Canada and have been promoting it to ophthalmologists, and as you see, our sales have been growing.
You've got a fair number of products being developed in the pipeline. What's the one that you're most excited about?
At this point, Diclegis is the one that we're really interested in. So Diclegis is the only FDA-approved product to treat pregnancy-induced nausea. So women who suffer from the condition, this drug is dosed 4 times a day. So as you're vomiting all morning, you're trying to take a pill 4 times with water. You never know how much drug you have on board when you throw up after taking your dose. And it's a patient population that, as you can understand, is very sensitive to over-medicating. Making it a once-a-day patch is a real elegant solution to the dosing. So patients or customers would put it on at night, and the drug slowly releases through the transdermal patch. In the morning they have symptom control, and then by midday, if they're feeling fine, they can pull the patch off. So it's reversible. You can stop dosing, and it's, the excitement around it is just that. It's an intuitive benefit to the current 4 times a day oral. The Diclegis as a product is interesting to us. It does about $200 million a year of sales in the U.S. But even though it's a prescription product, all of that revenue comes out of pocket. So these patients pay out of their own pocket. It's not reimbursed. And I think as the narrative of drug pricing continues in the U.S., and it'll be those specific products that are not paid by the system, they're actually paid by the customer, by the patient, are going to be even more attractive because they won't suffer from price pressure the way some of the examples that are in the media are going to suffer from as we go forward.
Now, the marijuana sector is not as hot as it was from a stock market perspective, but it's still a fascinating space for a lot of people. You moved into that, and in terms of, speaking of drug delivery and giving accurate doses and so on, what's the opportunity there, do you think?
A few months ago, we announced results from a 400 clinician survey where we spoke with 200 clinicians in California and 200 clinicians across Canada about their resistance to recommending cannabinoids. And the 4 biggest kind of hurdles they felt were there's a lack of safety and efficacy data. The dose variability is day to day. They don't trust that dose you're taking today to be the same as tomorrow. The way you're dosed has issues. Inhaling can be toxic. Ingesting oils, it's not a very precise nor safe method. And there's manufacturing concerns. So we don't manufacture, but those other 3 concerns they had, those other 3 issues, we solve those problems at an FDA level, Health Canada level every day. Those are things that we know how to do. I think, if you look at our commercial efforts, We're in the epilepsy space, we're in glaucoma, we have an anti-nausea patch. 3 areas, neurology, glaucoma, nausea, where there's a lot of anecdotal evidence that cannabinoids could have an effect. So for us, we're looking to do, we look at cannabinoid just as another payload. The same way we look at drug delivery, we think there's an opportunity to take specific formulations of cannabinoids and develop a differentiated product than what you're currently getting just off the websites of the large LPs.
Doug, let's look at the fundamentals. Revenue was impressive in the last quarter, year over year. Tell us why it's a little bit lumpy and inconsistent, and also when do you expect to be profitable?
Yeah, we're still pretty early in our launch of these products. So with Vistitan, the revenues that you're referring to are Q1 numbers. That represented the third quarter of launch. In Canada, you have to negotiate price with each province. So those provincial formularies are how you get reimbursed, and that process can take 6 to 9 to 12 months, depending on the province and the kind of the backlog. So when you get an approval in a bigger province like Ontario, you'll get big stocking orders from the pharmacy. So there's going to be some lumpiness for us still for a while. We expect to launch the Santen drug this fall and start getting formulary access for that. And our goal is to, we want to have the business break even as quickly as we can. The commercial infrastructure broke even in Q1 and started to contribute capital to the rest of the business. And we'd like to have the whole business break even as we come out of this year into early part of next year. And we think that Santen product can do 3 to 5 million in revenues for us, and will ensure that we'll be getting into the black. We expect hopefully the first part of next year.
Some 52-week highs and lows for you now, starting with HNZ. This is a company that specializes in helicopter services. Now, the stock had been bumping its head at 14 a couple of times here in the past year, but breaking out pretty sharply recently, so a 52-week high for HNZ. We also have a 52-week high here for Pan Orient Energy, one of the few energy stocks actually doing well, busting through 165 pretty smartly there recently. Now, we also have some 52-week lows with the Exchange Income Fund continuing to struggle, much higher levels here in the early part of the year, but breaking through $31 recently. The other one, another energy stock, we're seeing a lot of energy shares continue to be under pressure. We'll have a look now at the Interpipeline. Remember a couple of years ago how well these pipeline stocks had done, but Interpipeline breaking through support at $26, so a 52-week low there for IPF. Last week we heard from Jason Bach, the CEO of Solar Alliance. This week we sit down with him. The company has announced a bevy of news, including an acquisition, a joint venture, and a financing. Here's our chat with Jason Bach. So I've asked you this a few times. They're going to ask you again. You're probably used to giving the pitch. Tell us about Solar Alliance and what you do.
We're a sales and marketing company that focuses on Southern California initially for the sales and installation of residential and commercial systems. We manage a team of salespeople that canvasses San Diego to Los Angeles and sells residential systems direct to homeowners. The average cost of electricity in San Diego is 24 cents a kilowatt hour. We can generate power at 14 cents per kilowatt hour. So it's a great opportunity for homeowners in Southern California to save a whole bunch of money on their utility bill. We also develop and sell commercial systems to larger customers. Systems on the order of hundreds of kilowatts to a few megawatts. And we have been focused on the building of our pipeline of systems over the last year, and now we have some interesting acquisitions that will help us complete and deliver that pipeline as revenue.
So exciting times for your company. You just struck an acquisition. Tell us about that.
So we've went forward with an acquisition, expanding our reach outside of California in a couple of different ways. We signed a joint development agreement with Thompson Machinery, which is part of the Thompson Caterpillar Group, owned by the Thompson family of Nashville, the same group that owns an interest in the Nashville Predators. Right. Thompson Machinery has been around since 1944, operating their Caterpillar dealerships. And we formed a relationship with them so that we can access their skill set, their customers, and their long-standing relationships in 5 states in the Southeast. They're exposed in Tennessee and Mississippi with their Caterpillar dealerships, and they've been selling a lot of product through those dealerships. So we now are going to jointly approach their customer base and sell them commercial solar in partnership. If that works well in the Caterpillar dealerships like we anticipate, we're hopefully going to expand that to other dealerships outside of the Southeast. So it's a very synergistic relationship and joint agreement where we split the benefits of these types of sales and developments. Additionally, we've just announced the acquisition of a Thompson-owned solar company called Aeries Solar. Aeries is a strong technical team in the southeast of America where they have developed an $18 million pipeline of projects that we can help execute on and deliver to the market. So potentially a revenue boost to our company of $18 million over the next year or so as we execute their pipeline. They have a very strong technical team that's going to complement our team. We've been growing rapidly in the residential space. This complements our targets on our commercial space and will help us generate even more revenue this year, especially because last year we didn't have a commercial section. So this inorganic growth and this opportunistic relationship has helped us bring a lot more sales and revenue to the company.
And as you say, you're branching out geographically as well. So you announced a financing in late April, I believe it was, and that's close to closing, or it has closed?
We are in the process of closing this financing right now. We're raising probably between $3 to $5 million total, and that will be the fuel necessary to help grow these teams. Previously on your show, we talked about the relationship with William Shatner and how we want to use that to focus on customers and residential customers and bring more eyes and more views to ourselves so that we can sell more solar and we can help more people save a whole bunch of money on their utility bill and be exposed to distributed generation and all the interesting synergies that come along with that and the convergence of electric cars, batteries, and all these neat things that the market is moving towards. So the financing helps us maintain profitability in our operating companies, and we have been profitable in San Diego in our Solar Alliance of America subsidiary that we acquired in 2015, and we want to continue that, and that's an interesting inflection point for our whole group of companies, is targeting and obtaining profit this year. And this cash helps us grow our businesses to do that.
Anything else, Jason, you want to touch on?
I think valuation-wise, we've just started telling people about our company. I think this is an exciting time. We haven't marketed a lot over the last few years, and we're now at the point where we've de-risked the company. We've firmly established ourselves as a leader in the solar space in Southern California, and with our model, our creative model, bringing a number of companies together under the Solar Alliance. So I think we're, as many CEOs would say, we're undervalued, and I think our valuation is backstopped by our revenue and profit. So we're definitely at an exciting point, and we certainly want to tell as many people about that as possible.
From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. If you want more great investment ideas through our Capital Ideas Weekly Digest and our Morning Note, subscribe to capitalideasresearch.com. We'll see you next time.